Good morning to everyone watching live with me here on BAM YouTube. Let me know in the comments where you are tuning in live from today. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. On today's Hot Sheet, I will cover existing home sales reported by NAR, Wall Street's investments in single-family homes, CoStar earnings, and the next interest rate hike. Today is Wednesday, February 22nd, 2023. I am Byron Lazine, and the Hot Sheet starts now. Welcome back to the Hot Sheet. Hit that thumbs up if you want to support the show. Consider sharing with somebody who wants a 24-hour look back on the housing market. We've got a lot to cover today, starting with NAR's existing home sales report that just came out yesterday. Existing home sales descended 0.7% in January. That marks the 12th consecutive month to a seasonally annual adjusted rate of 4 million sales. So for 12 months now, total home sales have continuously dropped. That speaks to what has happened with mortgage interest rates. We saw last year they over doubled in the fastest rate ever recorded. We saw it peak out at 7.37%, and we're getting now very close again as we sit here in February 2023 of getting over the 7% mark. We'll talk about where rates ended up yesterday, but we are just barreling down, facing that 7% mark again after briefly touching 5.99 for that one Thursday just a few weeks ago, or less than a few weeks ago. Inventory of unsold existing homes did grow, so that's a good number. We were talking about the last number being recorded at 970,000 across the country. It popped up just a bit, 2.1% from December to 980,000 units. Now remember, this is total homes available on the market, which we talked about on yesterday's Hot Sheet, has dropped. So active listings, I think that's a better indicator. This number here is different from that because it also includes that number, and it includes all of the homes that are under contract with a buyer and a seller. Okay, so if people are pushing, a contract out, maybe they're like, hey, the interest rate's going to drop. Maybe I can work something with the bank. Maybe I'm trying to get some more cash. Maybe I'm taking a closer look at inspections. Maybe I'm extending those inspections as a buyer because I'm using this interest rate news. I'm using everything that's swirling, the inspection report, to negotiate. We know the more you negotiate, the likelier it is that the deal gets killed, but also, the likelier that you could maybe get some type of a price reduction as long as there's not a line of buyers waiting for that particular property. So the 980,000 going up from 970,000, it's positive. We want to see more inventory. We've been talking about that forever, but it's not everything. It's certainly not a huge number that I would focus on. It's not like, okay, wow, inventory is going back up in the right direction. We're still under 1 million. We need to be closer to 1.25 to 1.5 million of existing homes on the market. Remember, like we talked about yesterday on the Hot Sheet, that number has been declining week over week of active listings, of what's available on the market. New listings at its lowest mark in 5 years. All those slides that I shared yesterday are always available in the daily download, as well as all the ones we're going to go through today, which they are extensive. All our sources and slides can be available in one link. So let's just take a look, brief overview of NAR's report that came out yesterday. We'll go rapid fire here. Total existing home sales, again, seasonally adjusted annual rate, has now hit 4 million. Okay. We haven't seen that range since this 2005, 2006 timeframe, when it was 4,090,000. Okay. So pretty interesting there. There was the last time we hit it. Here we are today. It's been on a sharp decline down as of late. Okay. So, and I'm sorry, we haven't seen that since 2020. I think I said 2005, 7. Obviously, that would not be the case in those timeframes. 2020 is when we saw that sharp decline. This is the COVID decline. And then obviously we popped up those last few years. Okay. So that's where we're at on seasonally adjusted total home sales. Median price of existing homes. This is good news overall. Okay. Some buyers in certain price ranges, in suburbs, in rural areas might not be feeling this, but we are seeing prices go down. So affordability for some buyers in some markets is getting to become more of a reality. This was super unsustainable here. This number, median price of existing home sales, going in the right direction. Median home price, existing home sales median price percent change year over year. You can see here that this is a sharp decline from just 1 year ago, and this is year over year. So we're just hanging on in the positives in January of 2023. We could see next year, or sorry, next month or the month after, a negative number on that as these months here start to drop off. As those drop off, you would anticipate flat year over year number, maybe even into the negatives. Obviously, Zillow just changed their report saying we're going to be in the positives overall for the year. So they're expecting somewhere late in the spring for things to pop back up. Okay. There you go on the price chart. Total existing home sales percent year over year. And this is where you've just seen total home sales completely plummet as they started to jack up that interest rate. And January down 36.9% was the report from NAR for January. Realtors Confidence Index Survey. I don't put a ton of weight on this all the time, but it's worth looking at. Okay. So percent of the sales, this is reported by sellers. Okay. By realtors. So realtors reporting that their percent of first-time home buyers right now is 31% over last year's 21%. They are reporting that sales to investors, this is good. This number is really good based off of the next story that I'm going to cover. Okay. Percent of sales to investors is 16%, down from 22%. I like this number the most out of, this entire survey from realtors. Cash sales up. That makes sense with where interest rates are, only up 2%, 2 percentage points of sales. Distressed sales, still not seeing those go up in any significant way. Days on the market are up to 33 from 19. So that should put more pressure on price as sellers, are on the market longer. And then sales by price range. I just thought this was interesting because here's where the majority of the sales are happening. It's from 100,000 to 500,000. That's 68% of the sales in this country are happening sub 500,000. We know we need more inventory there. That's where we're seeing buyers really struggle with, home shopping and being able to find affordability and getting into these competitive price situations. So 68% of the sales are happening from 100,000 to 500,000, right? So definitely, if you're an agent right now and you're typically a little picky on price, understand that 7 out of 10 deals that sell in your market are probably going to be selling in that price range, unless you're in, Beverly Hills or Miami or one of those markets that we mentioned in California or Florida a couple hot sheets ago. Months of supply is improving. Okay. We want this number to go up to what would be a more normal market, but we're not anywhere close to a normal market yet. Months of supply has been sitting since they started jacking up the interest rates and since we got close to 7% at 3 months. We're only at 3.4 months. This is seasonally adjusted supply. Okay, so in a normal market, months of supply would be at 6 months. That means the sellers and the buyers neither have the advantage. This is a normal market across the country. I know Redfin's typically goes off of a 5-month measurement, but historically the number is 6 months. Okay, we're still sitting at 3.4 months of supply for existing single-family homes. It's taking a lot longer for sellers to say, you know what, I'm going to go on the market, right? We're not seeing new listings right now. We're at the low point in 5 years. It's taking a lot longer for them potentially to, drop that price if they are on the market. So they're just going to stand put or take it off the market. They're just not getting their homes listed onto the market. That's generally what's happening. The good inventory is getting scooped up. We need this thing to get up to 6 months of supply to be closer to a normal market. We're sitting at 3.4. So when everybody says inventory is going, increasing dramatically, overall across the country, we're still 2.5 months away from a normal market. Okay. There's a lot of home shoppers that would take 5 to take, 6 being normal. Certainly 7 would be welcoming to them, just based off of they'd have some more flexibility on negotiating and not into some competing offer situations. Okay. So months of supply still has a way to go. And then here's a chart you can grab down below. And this is by region, where these percent of change in sales from 1 year ago are taking place. You got the Northeast, Midwest, South, and West. And so you see here from 0 to 100K, 100 to 250K, 250K to 500K, 500 to 750K, and then the luxury price points. You see luxury price points in the West specifically are taking a beating. Northeast, they're down pretty significantly there. But overall, the West numbers outside of this, 0 to 100, which I don't know what you buy from 0 to 100 in the West taking a huge beating on total sales distribution here down below. And then you've got median days on market. And it's really these higher price points that we're seeing the median days on market move the most. Okay, so that's your summary on NAR's existing home sales report, which came out yesterday. You can grab all those charts below if you want to use those for any purpose necessary. Currently about 5,200 listings shorts of a balanced market here. That's William, and he's in Charleston. Charleston isn't that big of a, I mean, I know the general area can get a little bit big, but that sounds like a lot of homes being short. I know Charleston's been very competitive. Beautiful place that you live there. So and let me know in the comments, what's the market like where you are right now? Are you short of supply, or are in one of those few markets where maybe, I'd love to know if there's any markets above 6 months of inventory. Okay, nationally we're at 3.5 months, but are there any markets above 6 months of inventory? Are you in one of those markets? Okay. Here's a market that Wall Street's been looking at closely. It's the housing market. They've been buying up homes at a rapid rate last year and the year before, certainly coming into 2022, 2021. That's all you heard was Wall Street is buying up single family homes. Wall Street's thesis is that this is going to become a renter nation, that more and more people are going to perpetually rent their home as opposed to owning their home. It's why they're pushing their chips into the middle now and haven't done so at this scale ever in the past. They believe we're in a position where Americans are going to have to rent, and it's going to be more affordable for them to rent than it is to own a home. They know that owning the asset is a predictable way to generate wealth for them, for their fund, a predictable way to guarantee a return for investors when you have a large, swath of single family homes and you're renting these homes out. You can say, okay, rent's going up this much a year. We're going to get this much return. We're putting this much money down. They can predict how much they're going to be able to return to their investors. So for the home shoppers that are like, okay, interest rates are up, and hopefully if inventory goes up, I'll start to get, a lower price. Then there's information like this that suggests their competition is going to be Wall Street, which has a little bit of a bigger pocketbook. Wall Street has purchased hundreds of thousands of single-family homes since the Great Recession. Here's what that means for rental prices, is according to reading from CNBC. So corporations backed by private equity groups like Blackstone and Pretium Partners bought tens of thousands of homes across the U.S. Sunbelt. Now, tens of thousands of homes is a lot, but it's still not enough to completely shift the balance here. But what they went on to say, and this is from MetLife Investment Management, is that institutional investors may control 40% of U.S. single-family rental homes by 2030. And there's a group of Washington, D.C. lawmakers that believe Wall Street needs to step away from the market. That should be, by the way, a bipartisan approach at this point. Hey, I mean, I believe in a free market, and I've said it in 2021 when they're buying. I'm like, because people group investors, your mom and pop investor buying 4 or 5 homes in a local market to actually have a retirement as opposed to buying stocks. They put them in with this number here, which is the institutional investor may control 40% of single family homes. The institutional investor and the investor that's just building a small portfolio in the town that they live in are two totally different things. Let me know in the comments if you agree with that. I believe in a free market, right? But I also believe that it's clear that the way you can control the fastest way to control your retirement and wealth in this country is to eventually get into home ownership and to have, if you're going to be in an area for a long time, have a really stable equity situation in your home, right? A mortgage that you can pay off and have a forced savings, or basically buy your house cash and not have to pay the rent, right? You're going to have appreciation over time. We know that when you compare renters to homeowners, they're 75x less wealthier than homeowners. And we already know, you fast forward through all the boomer generation, what's going to happen to Social Security? How are we going to continue to fund all of these, all this social spending that we have in this country? Well, if you take, everybody and put them into a rental situation, we're not able to actually have a great retirement, that situation is going to get even worse. What's worse than that is you've got guys like Grant Cardone coming out and saying, putting fuel on the fire, that he and other real estate investors are going to save the day and they're going to prevent a home crash. Why? Because as prices go down, these investors, Cardone being quoted here on Business Insider, will step in and pick up single family homes at lower prices with less competition. That being said, there will be no housing crisis or housing crash, rather. Investors like myself will save the day and step in and buy homes. I went deep on this on yesterday's Real Word. Go check out the Real Word podcast if you want more. Good for Grant for getting himself in the news, staying relevant. He loves the attention. He's got a lot of products to sell, so he should. But there is absolutely no case in which investors buying up single family homes are going to save the housing market. It's going to save very few sellers from dropping from maybe 5% loss down to 10%, but it's going to eliminate a whole bunch of home shoppers from the market. It's going to make a perpetual renter over time. And I don't think that's good for the future of the country. Let me know if you agree with me there. Okay, CoStar just reported their earnings yesterday. Very interesting. A couple things I want to highlight here from the earning call with the CEO, Andy Florance. Number one is that CoStar Group CEO, Andy Florance, says the firm will not be acquiring Move real estate business, so Realtor.com, from News Corp. Okay, CoStar had been in talks to purchase Move Inc. from News Corp for about $3 billion. But Andy Florance said in that conference call yesterday that isn't the case. News Corp said that it will continue to assess opportunities to support its strategy to pull value from its digital real estate services segment. Realtor.com is obviously attractive because its online traffic is substantial from people who want to buy and sell, according to analysts, according to anyone with eyes that work. That's an obvious right there, Wall Street Journal. Thank you very much. For News Corp, parent of the Wall Street Journal, the deal would have brought a pile of cash at a time when the company is facing challenges, including slowing spending from advertisers, so on and so forth. So interesting there that they said, hey, this deal is now off the table. Doesn't mean that they won't rekindle the deal. It means that my prediction gets a little bit closer, is that maybe Andy Florance is going to go in and do a hostile takeover of Redfin, because it'll only right now, according to the market cap, maybe cost him $1 billion. Maybe he throws in a few more shekels there. And I think Redfin's got better technology. Now, what Andy Florance is going to do with an acquisition like this, I'll get to that in a second. But if you are interested in the earnings, let me just cover that for a moment. They had revenue of up 13% year over year between October and December, and they anticipate revenue being between $575 million and $580 million for quarter one. The forecast was $585 million. So yesterday, after hours, the stock did go down over 10%. But they've got a ton of cash. They had a profit of over 300 million last year on, I think, about 2 billion plus in revenue. Don't quote me on the 2 billion plus, but in the 300 plus million in profits. So he's a real player, substantial player. He's got a 3x market cap of Zillow. When I say he, I'm talking about the CEO, Andy Florence. This guy doesn't mess around. He does not screw around. He's coming in for the residential space. If you've listened to my past content, you know that. But here's some things that stood out for me on Andy's earnings call to investors. Okay. He's gone on other portals. He didn't name names, but we're talking about Zillow. We're talking about Realtor.com, which he was looking at. Maybe we're talking about Redfin. I don't know. He's just saying other portals. And he says, quote, they're remarkably awful in the experience that you get on them. Okay. So he's never been one to be shy about taking shots on the industry. And he says these portals for residential real estate are remarkably awful. Now, he believes, and this is his words, that if it's your listing, it should be your lead. Listen, hit the thumbs up if you're a listing agent for residential real estate, and you agree with that. I know a ton of agents. They're just going to focus on that. Wow, I like this guy. Your listing, your lead. Go check out what he does with LoopNet, the commercial site, which, they dominate the commercial space. You will pay substantially. Now, a lot of listing agents say, fine, that's fine. Okay, but you will be paying for those buyer leads on your listing. It's not your listing, your lead for free. He's not a nonprofit organization. Trust me, if CoStar buys Redfin or one of these other portals, or, they're talking about homes.com on the earnings call and how it's up to 20 million unique monthly traffic. That's still 10% of what Zillow does a month, by the way. So they want to make an acquisition in residential. It won't be a nonprofit business. You will get charged substantially, but he wants that to go to listing agents because he believes that'll be a better consumer experience. He doesn't like when he goes on these other listing portals and he's getting bombarded by a whole bunch of different agents, or, an agent that's not the listing agent, right? So he thinks that this will serve all agents better. It'll certainly change the game for people that primarily have a buy-side business. If you're primarily working with buyers, we know there's some stuff at trial looming in October that's going to touch on this. And then if, we talked about Zillow earnings call, referencing something like placements on listings, right? Where, listen, if you're going to charge me to place my listing at a more superior spot, I'm going to want something in return, which should be the leads, right? So that would cut into those buy side. Really interesting. Either way, Andy Florence did say on Tuesday's conference call that he sees other M&A opportunities in both commercial and residential, but that they will spend probably more on residential. They tried in 2021 to buy CoreLogic, but CoreLogic, of course, instead agreed to sell to two private equity firms. So there's your CoStar update on that. We've got a short Fed update for you as well. This news has been happening the last 24 hours. It's been bubbling up a little bit more because the Fed is going to release their minutes today from the last meeting. So we covered Jerome Powell's speech, and we, obviously the 25 basis point hike, but we didn't have the minutes. We didn't know if they were actually discussing a 50-point hike, right? There's a lot of, the last 24 hours, a lot of people saying, hey, we believe they were discussing a 50-point hike. We'll see what happens in the minutes here. And now we believe, and according to Bloomberg, that these Fed minutes will show support level for larger hikes. So for the national interest rate hike, the readout could reveal more officials considered a 50 bip move. Tone could hint at how officials are interpreting this recent data. Obviously, the recent data has shown that the economy might not be as cooling as fast as we had hoped or wished for. Okay, so they're going to publish minutes from that January 31st, February 1st gathering, which they voted to raise rates by just 0.25%. They're going to be meeting again next week. Okay, so they release their minutes now. They meet again next week, and they're going to do another rate hike. The thought originally was, hey, maybe this might be just 25. And then we've been talking about the last couple of weeks. I think it could be 50 basis points. I don't know. Maybe they go 75. I don't know. If they do, we're going to be probably surpassing that 7.37 30-year fixed mortgage rate. They're not totally in line. We're going to talk about the 10-year in a second. The 10-year is a better indicator. But we've seen what happens as they continue to increase the federal interest rate, how the 10-year has responded and how the 30-year has responded. So right now we're in a target range of 4.5 to 4.7. Just this morning on CNBC, St. Louis Fed James Bullard is pushing for faster rate hikes. So he'd rather see maybe, a half a basis point or maybe even that 0.75 basis point next week. He wants to see a top rate of about 5.5%. He said, 5.4%. We're at 4.5 to 4.75. So he's talking about basically another full, point up. He's saying, let's go faster. He believes the economy can handle it. That's the good part of what he said here today. He says, hey, I think the economy can handle it. We've got strong jobs. And he believes, if we go a little bit faster, then we're not going to have as much pain for long term. So that's what he said on CNBC today. We'll see when those meetings come out today, if there's anything in them worth covering on tomorrow's hot sheet. One other thing I did want to just mention before we sign off here is what happened this morning with a new reading on mortgage purchase application. Okay, it's down 18.1%. To 147.1. You can see that there. And this is the lowest purchase application reading of the 21st century. Okay, so you can see that this is lower than at any point during the crash of 2009, 2010, when we bottomed out in 2012. It's lower than all of those readings. So there are far less buyers out there in the market using a mortgage right now. Don't get this confused with how little inventory. We talked about the little inventory. Don't talk about how much demand there is, especially if you're talking to a seller. Hey, there's great demand out there. No. There's a significant lack of inventory, which creates an environment with the serious buyers that you have right now where you can get top dollar for your home. That's the conversation with the sellers. When we say there's incredible demand, that would be a little bit short-sighted. We're at the lowest purchase application reading of the 21st century with the news that came out today. That should be something at least that the Fed takes into consideration as a positive as they wanted to reset the housing market. And they certainly have done that. The 10-year seems to have been completely reset from where we were at one point just a couple of weeks ago. Okay, so the 10-year is staring down, hitting 4% 10-year yield, which would be the second time we've hit that since 2008. If we look at the 1 year, the last year mark, we hit that in about late October or late September, early October. We hit the 4%. We know what happened when we hit 4%. We went up over 7% on the 30-year fixed. Things slowed down significantly, and we hit a top end of 7.37 yesterday on the 30-year fixed. And look at this number here, just in the last couple of weeks, how high it has shot up. These are abnormal moves. Yesterday, we ended on the 30-year fixed at 6.87. The 10-year, as you saw, is down a tick today. So hopefully we can hold firm at that 30-year fixed number as opposed to going up again as we have day over day. As of late, we just keep seeing an increase. Hopefully we can get a flat reading or maybe even a tick below if the 10-year can drop a little bit more. We'll see what happens today. Premiering at 11 a.m. here on the channel. We've got a Massive Agent podcast. Make sure you're subscribed to the channel so you don't miss anything. Please consider sharing this hot sheet with somebody who can benefit. And I'll see you back here tomorrow live at 9:30 a.m. Eastern. Till then, toodaloo.